At 2:17 a.m. Washington time, the first headlines hit. Missile strikes. Retaliation. Airspace closed. Oil jumps 6% in minutes. By the time New York wakes up, futures are already bleeding. And somewhere, someone is whispering the same sentence you're probably thinking right now. Is this the one? Is this the crash? The idea of the United States and Israel attacking Iran isn't just geopolitics. It's math. It's oil tankers. It's shipping lanes. It's inflation. It's interest rates. It's your 401k. It's your SIP. It's your job. And the uncomfortable truth is this. Markets don't crash because of explosions. They crash because of chain reactions. So let's slow this down. Imagine a scenario. The United States coordinates strikes with Israel against Iranian military infrastructure. Iran retaliates, not necessarily with direct invasion, but with something more efficient, the Strait of Hormuz. If you've never heard of it, it's a narrow stretch of water between Iran and Oman. It looks small on a map. It doesn't feel dramatic, but roughly 20% of the world's oil passes through that one choke point. 1 in every 5 barrels. Block it, even partially, and oil prices don't just rise. They spike. In 2019, when tankers were attacked in the Gulf, oil jumped sharply within hours. During the Russia-Ukraine invasion in 2022, crude briefly crossed $120 a barrel. Now imagine that kind of spike again, but this time layered on an already fragile global economy. Because here's where it gets interesting. The world isn't in a position to absorb another energy shock comfortably. Inflation may have cooled from its 2022 highs, but hasn't disappeared. In the United States, the Federal Reserve has spent years fighting inflation with higher interest rates. Rates are still elevated compared to the pre-pandemic era. That means borrowing is expensive. Mortgages are expensive. Corporate debt refinancing is expensive. So when oil jumps, transportation costs jump. Airlines pay more. Shipping costs rise. Manufacturing becomes more expensive. Food prices creep up. And inflation, which was finally calming down, gets a second wind. Now the Federal Reserve has a problem. If inflation rises again, they can't cut rates. In fact, they might have to keep rates higher for longer, or even raise them. And this is where markets begin to sweat. Because stock markets are not allergic to war. They're allergic to higher rates. Look back at history. During the Gulf War in 1990, markets initially fell, but recovered quickly once the outcome became clearer. After September 11th, markets crashed, yes, but the Federal Reserve cut rates aggressively. Liquidity flooded the system. The damage was contained. The pattern is subtle but consistent. If war leads to easier monetary policy, markets often rebound. If war leads to tighter monetary policy, that's when things break. So the real question isn't will there be bombs? It's will inflation spike? Let's talk about oil at $150. At that level, gasoline prices surge. Consumer confidence drops. People spend less. Corporate margins shrink. Now combine that with already stretched equity valuations in parts of the market. Tech stocks priced for perfection. AI companies trading at multiples that assume flawless growth. Higher oil means higher costs. Higher inflation means higher rates. Higher rates mean lower present value of future earnings. That's finance speak for this. Expensive stocks become very fragile. But here's the irony. Defense stocks might rise. Oil producers might surge. Energy exporting nations might benefit. Markets don't move as one giant block. They fracture. And that fragmentation can be dangerous because passive investing has made everything interconnected. ETFs bundle hundreds of companies together. When investors panic, they don't carefully sell only vulnerable companies. They hit sell on the whole basket. Liquidity disappears faster than people expect. Now let's zoom out. Iran is not Iraq in 2003. It has regional influence through proxy groups. It has cyber capabilities. It has the ability to disrupt shipping without formally declaring war. And global supply chains are still recovering from pandemic shocks and the Russia-Ukraine conflict. Add one more disruption, and you test the resilience of a system that already feels tired. Here's another uncomfortable layer. China. China imports a massive amount of oil from the Middle East. If the Strait of Hormuz becomes unstable, China's energy security becomes a strategic concern. Does China step in diplomatically, economically, militarily? Even uncertainty about that question can shake markets. Because markets hate one thing above all else: unknown escalation paths. Now let's address the phrase everyone throws around during geopolitical crises. The biggest market crash is coming. It sounds dramatic. It gets clicks. But is it realistic? Historically, most geopolitical shocks create sharp, fast drops followed by recoveries. Why? Because wars are often regional, even when they feel global. Economic systems adapt. Oil reroutes. Strategic reserves get released. Diplomacy kicks in. The United States holds hundreds of millions of barrels in its strategic petroleum reserve. Other countries coordinate releases. OPEC adjusts production. The system bends. It doesn't immediately snap. But here's the catch. Crashes usually happen when something fragile was already breaking. In 2008, it wasn't just housing. It was leverage, hidden risk, structured products no one fully understood. In 2020, it wasn't just a virus. It was a sudden stop in economic activity combined with leverage. So ask yourself this: where is the fragility today? Commercial real estate is under pressure. Some regional banks still carry unrealized losses on bond portfolios. Government debt levels are historically high. The United States is running large fiscal deficits. Now, imagine oil at $150. Inflation returns. Rates stay high. Interest payments on government debt rise further. The bond market starts demanding higher yields to compensate for risk. And if bond yields rise sharply, stock valuations compress even if earnings don't collapse. That's not cinematic. It's mechanical. And mechanical systems fail quietly at first. There's also the psychological layer. Markets have been conditioned to believe in the Fed put, the idea that the Federal Reserve will always step in to save markets. But if inflation is the enemy again, the Fed's hands are tied. You can't print your way out of an oil shock without making inflation worse. That's the trap. And that trap is what makes this scenario different from some past conflicts. Not guaranteed disaster, but constrained policy response. Now, let's add one more variable: energy transition. The world talks about renewables, electric vehicles, decarbonization. But today, oil still runs the global economy. Planes don't fly on optimism. Cargo ships don't move on solar panels alone. A sudden oil shock exposes how dependent we still are. That realization can shift capital flows dramatically. Into energy, into commodities, away from high-growth tech. Rotation can feel like a crash if you're concentrated in the wrong place. So, is the biggest market crash coming? Maybe not in the way headlines suggest. It might not be a single dramatic 40% collapse overnight. It could be something slower, a grinding repricing, high-flying sectors deflating, indexes flat for years while inflation eats real returns. That kind of crash doesn't trend on social media. It just quietly erodes wealth. And yet, there's another side. If escalation remains limited, if oil spikes briefly but supply adjusts, if inflation doesn't reignite aggressively, markets could sell off sharply, then recover within months. Because capital always looks forward. And once uncertainty peaks, even bad news can become relief. So we're left with probabilities, not certainties. War headlines create volatility. Oil determines inflation. Inflation determines rates. Rates determine valuations. Valuations determine whether markets bend or break. It's a chain reaction. Right now, the world is balancing on several pressure points at once. Middle East tensions, high global debt, sticky inflation, elevated valuations. None of them alone guarantees a crash. Together, they create sensitivity. So the real question isn't whether bombs fall. It's whether the economic system can absorb another shock without triggering something deeper. Because history suggests this. Markets don't collapse simply because something bad happens. They collapse when something bad exposes something weak. And the uncomfortable truth is we don't fully know where the weakest link is until stress tests begin. So if the United States and Israel escalate against Iran, the first reaction will be headlines and oil spikes. The second reaction will be inflation expectations. The third reaction will be bond yields. And somewhere between the second and third reaction, markets will decide whether this is just another geopolitical scare, or the moment the hidden cracks finally show. And that decision won't be made in war rooms. It will be made in bond markets at 3 a.m., in oil futures pits, and in the quiet repricing of risk across the globe. The bombs, if they fall, will be loud. The real danger, as always, will be silent. So here's the unresolved question. If the next shock hits tomorrow, is the global financial system strong enough to absorb it? Or have we simply been mistaking calm for stability?